Hey everybody, it's John King with Summit Funding. It is Friday, the 10th of March. Wow, has this been an action-packed week? Probably one of the biggest informational weeks I've had in my career for a couple of reasons, and I'm not playing around with you. So the first thing, the topic I'm going to talk about first is a brand new program releasing at the end of this month that we're collecting applicants for now that will grant first-time home buyers 20% of the purchase price in down payment assistance. Now, I use the word grant as loan. It's going to loan you 20% of the purchase price in down payment assistance. I'll talk about that in a minute. And then I'm going to talk about rate volatility, where interest rates are at, why we've seen a lot of volatility this week from places we wouldn't have expected, and what's going to happen with interest rates next week. So stick around for the whole video. You're going to cover all of that, but let's get started with the first topic. California Dream for All. That is the new program. I am super excited about it. I've got a lot of educational outreach that I'm putting out, and I need you to get educated on this, because whether it's you, a friend of yours, a family member of yours, you know somebody who is thinking of buying a home, doesn't want to buy the home because either they can't afford the payment because interest rates have gone up so much that they just don't qualify anymore, or they're unwilling to make the monthly payment because interest rates have gone up so much that they're just not willing to make that monthly payment. This program will fix that for most of those people, and you need to get them connected with me. Here's what the program does. It provides you a loan of 20% of the purchase price in down payment assistance. Now, I am doing the next 3 weeks. This rolls out on March 27th. So on the 13th, the 20th, and the 27th at 7 p.m. every Monday night, I'm going to do a 1-hour informational webinar. You need to register for that by going to californiadreamforall.info and register. That page will have the link to register for the next upcoming webinar. Once the 13th is over, you'll have the registration for the 20th, etc. This program is a game changer. There's $500 million available. That sounds like a lot of money, but my rough calculation says it's going to help between 4,000 and 4,500 families. I did about a 30-minute informational webinar today, just talking about the benefits of the program. None of the details. Monday nights are about the details. Today was about the benefit. There'll be a link down below for you to watch that webinar as well, just to help you understand what the program is and what it's going to do for you. So really focused on the benefits. Next thing I want to talk about is interest rates. So little bit of quick history and just short history going back to last year. We saw interest rates in the 3s at the beginning of the year. They shot up in June and they hit around 6.25. They came back down to around 4.99 through August. They shot back up to October. They hit 7.25 at the end of October. They came back down to around 5.5 to 5.9% in January. Guess what? They're back up to 7. We're seeing that swing of interest rates going up and down, and it's not ending anytime soon. The shift where it moves up and down, I think over this year, we're going to see that lower and lower and lower, but we're going to keep banging our heads against the wall, especially for the next few months. So what happened in the last week? Well, first of all, Jerome Powell, the head of the chairman of the Federal Reserve, testified in front of Congress on Tuesday and Wednesday, and he really did, well, some would say a good job as a politician, some would say a bad job as a politician. And guess what? He's not a politician, but he told Congress what they wanted to hear. And then the next day he said something the complete opposite. And he said about, hey, we raised interest rates a lot so we can slow down inflation. And so we're going to raise and pause. And then he said, well, we're probably not done raising rates, and we're going to keep raising interest rates. He's making the market's head spin. He's doing exactly what he's not supposed to do. He's supposed to calm the markets and be consistent, and he's not. So that created a lot of volatility this week in interest rates. Today was the jobs report. The jobs report in February was the first report that kicked off interest rates going up from the mid-5s to 7%. The second report was the inflation report. That inflation report happens next Tuesday. So a lot of things happening. The bad news is the jobs report showed lots of job growth. Same thing that happened in February, which means that is challenging to the market, concerning to the market, because it means that if there's still lots of jobs, there's likely still going to be inflation. The Fed is looking to lower the number of jobs, kind of get companies to start laying more people off so that people don't have as much money to spend. It's kind of a demented way of fixing the economy, but that's how they do it. So the bottom line is the jobs report today showed increasing jobs. That should mean interest rates go up. But there was a wild card. And the wild card was the second largest banking collapse in the U.S. history is a bank called Silicon Valley Bank. Silicon Valley Bank this morning was taken over by the FDIC. They changed the name of the company. They pulled all the money out of the bank. They put the money into a new bank. I think it's called the Federal Deposit Santa Clara Bank, something like that. And on Monday morning, people will have access to their FDIC insured balances. So pay attention to what the FDIC limit is on your account. Don't keep more money in a bank account that exceeds the FDIC limit, because although banks don't close very often, when they do, the federal government only insures up to a certain dollar amount. If you have more than that, you're stuck, you're sunk, whatever you want to say. I didn't mean to say suck. You're stuck because that money is not guaranteed by the federal government. So Silicon Valley Bank invested a bunch of money in 2021 because they were getting a lot of money from Silicon Valley venture capitalists, and they invested a lot of money buying mortgage bonds. Well, in general, those mortgages are going to perform really well. Nobody's going to default on them because the interest rates are super, super low. The problem is accounting rules say, well, those bonds aren't worth very much money because they're only paying 2.5% return. And you could go out right now and get money, a 1-year a treasury bond at 4.75%. So a 30-year bond paying 2.5, it's worthless. It's not worth very much money. And they have now a liquidity issue. They ran out of funds the other day. They ran short on money and they needed to raise cash. Problem is that the people who had deposits in that bank started pulling them out very quickly yesterday and the day before. And there was what's called a run on the bank. If you've seen It's a Wonderful Life, that's a run on the bank. If you haven't seen It's a Wonderful Life, go watch it. That's a run on the bank. The bank does not keep your money sitting in the vault. The bank uses your money to go lend out to somebody else. And so Silicon Valley Bank had lent out this money by buying mortgage bonds. Again, not like 2008, where you had banks that bought mortgage bonds that collapsed because the bonds were bad. Those bonds are super secure. They're just not worth as much right now. In the long run, they're going to pay back and they're going to pay their 2% over the lifetime. It's in the short run that you've got the issue. And so why does this all matter? Because it's really an issue with how shaky the economy is. And when you have the second largest collapse of a bank in US history, that is super concerning to the markets, and it causes a flight to safety, money coming out of the stock market. Bank stocks in the last 24 to 48 hours have dropped significantly because of the concern about economic activity that we're talking about. That money comes out of the stock market and goes into the bond market. Mortgages are a bond, which means if money is coming in without us trying to entice it, we don't have to entice it to come in. We can lower rates because money is begging to come in. When money doesn't want to come in to buy mortgage bonds, we have to raise rates in order to attract the money to come in. That's a super simplified version, but here's the bottom line. Volatility is the name of the game. So we see interest rates coming down some today, but whenever you have a headline like that, that's a wild card, well, that wild card can swing both directions. And the fact is we now have 2 months in a row of significant increase in jobs compared to what was expected. That typically says the Federal Reserve is going to be more aggressive in raising interest rates. We'll have to see what they do, but the biggest thing is going to be next Tuesday's inflation report. So join me next Friday, where I'll update you on the inflation report from Tuesday. We'll talk about where interest rates are at, and make sure you register for the California Dream for All program at californiadreamforall.info. Thank you so much for listening. Hope you have an absolutely amazing weekend, and reach out to me directly if you have any questions about this so I can help take care of you and anybody you know who's looking to purchase or refinance a home. Thanks, and we'll talk to you soon. Bye-bye.